Everyone wants to get rich investing. We hear all the time, just do what the billionaires do. But what if that's the very advice that's quietly destroying your wealth? What if their playbook is designed for a game you're not even playing? Welcome to Invest Education Hub, where we turn smart investing into simple decisions. Stay with us until the end, because understanding why you shouldn't copy the rich could be the most important financial lesson you learn all year.
All right, here's our game plan. We're going to start by peeling back the curtain on the hidden world of investing that exists beyond just stocks and bonds. Then we'll look at what a real billionaire's portfolio looks like. It'll probably surprise you. We'll do a deep dive into their number one tool, private equity. First the shiny theory, and then the gritty reality. And finally, we'll answer the big question: should you even try to copy them? You know, when most of us think about investing, our minds go straight to the stock market, right? Maybe some bonds. But the world's wealthiest individuals, well, they're playing on a totally different field with a completely different set of rules. And that field is called alternative assets. The key thing to get here is that their value isn't tied to whether the S&P 500 is up or down. Think about it. The price of gold is driven by inflation fears and global demand, not by Tesla's latest earnings report. And that disconnect is the secret sauce for building a portfolio that can handle pretty much anything. And man, this category is just massive. We're talking about the raw materials that build our world, like oil and copper. We're talking about precious metals, but then it gets into stuff you rarely hear about, like owning a piece of a private company, or funding new startups through venture capital, or even owning a slice of a giant apartment complex. It's a whole universe that most of us never see on our trading apps. So why does this matter so much right now in 2025? Well, because the old financial playbook has been thrown out the window. That classic 60-40 portfolio, 60% stocks, 40% bonds, it's just not the safe harbor it used to be. We've seen painful periods where both stocks and bonds fall at the same time. That's exactly why the big money is pouring into alternatives. They're desperately looking for something that zigs when the rest of the market sags. Okay, so we know what these assets are. Now let's look at the who. And you're about to see just how gigantic the gap is between how the average person invests and how the ultra-wealthy do it. Take a look at this. This chart is basically, well, it's probably you and me. It's the typical investor's portfolio. A big slug of stocks, a decent chunk of bonds, a little bit of cash sitting on the side. And look, there's nothing inherently wrong with this. It's simple, it's accessible, but, and this is a huge but, it is not even in the same sport as how billionaires manage their fortunes. Now, get ready for this. This is the billionaire's portfolio. It's almost a mirror image of the last one. Almost half of their entire net worth is in those alternative investments we just talked about. Public stocks and bonds, they're a minority slice of the pie. This isn't just a slightly different strategy, it's a completely different philosophy about money. So the billion-dollar question is, why? Why this huge difference? Is it just because they're chasing insane returns? Well, not exactly. The real reason is much smarter and far more strategic than that. It all comes down to building a portfolio that can survive a storm. The big idea is to add assets that are less correlated. That's just a fancy term for investments that don't all go up and down at the same time. So when the stock market is crashing, their private real estate holdings might be doing just fine. They're not trying to build a speedboat that's only fast on a calm day. They're building an aircraft carrier that can sail through any weather. All right, so let's zoom in on the undisputed king of these alternative assets, the one that makes up the biggest part of that billionaire portfolio, private equity. And on paper, in theory, the idea is honestly pretty brilliant. So what exactly is a private equity firm? Think of them like a team of corporate surgeons. They don't just buy a few shares of stock and hope for the best. No, they go in and buy the entire company, taking it off the stock market. Then they get their hands dirty. They install new management, overhaul operations, and execute a whole new strategy, all with one goal: to make that company way more valuable in 5 to 10 years so they can sell it for an enormous profit. And they often use a very powerful trick to supercharge their returns. It's called a leveraged buyout, or LBO. So the PE fund uses a little bit of its own money and then borrows a massive amount of debt to buy the company. But here's the crazy part. They put that giant mountain of debt onto the balance sheet of the company they just bought. It's like buying a rental property with a huge mortgage and then having the property itself be responsible for the payments. If it works, the returns can be absolutely astronomical.
And this is how the private equity managers get so rich themselves. It's the famous 2 and 20 fee structure. They charge a 2% management fee on all the money in the fund, every single year, no matter what. That pays for the nice offices. But the real prize is the 20. That's a 20% cut of all the profits they generate. You can see how this creates a powerful, relentless incentive to squeeze out returns.
When this model works, it can be absolutely spectacular. It can take a forgotten, failing company and engineer an incredible comeback. And there is no better example of this than the turnaround of the old internet icon, Yahoo. Yeah, that Yahoo. Remember them? A giant that had completely lost its way. Well, the PE firm Apollo bought it in 2021. They came in, installed a new CEO, and got to work. They focused on the parts that were still valuable, like Yahoo Finance and Sports, and they cut the rest. And today, the company is reportedly very profitable and is even planning to go public again. This is the fairy tale story the private equity industry wants you to hear. They're the saviors of struggling businesses. But that's only one side of the story. And for every heroic turnaround like Yahoo, there's a much darker, much more common reality that doesn't make the headlines. A reality that affects real people, real jobs, and entire communities in truly devastating ways. Let's go back to that 2 and 20 fee structure. It incentivizes profit, period. The model doesn't care how that profit is generated. So what happens when it's much faster and easier to just bleed a company dry than it is to patiently rebuild it? To understand this, we need to talk about Marsh supermarkets. Now, if you're not from Indiana or Ohio, you've probably never heard of them. But for decades, this wasn't just a grocery store. It was a local institution. It was a pillar of the community. And then private equity came calling. And the contrast with Yahoo could not be more stark. With Yahoo, the strategy was to fix and grow the business. But with Marsh, the private equity owner wasn't really interested in the grocery business at all. They were interested in its real estate. The strategy wasn't to grow the company, it was to extract its value. This is what's known as the asset stripping playbook. The PE firm did a sale-leaseback. They sold all the valuable real estate that Marsh owned for a huge, immediate cash payout. Then, they forced Marsh to start paying rent to operate in the very stores it used to own. The PE firm collected its fees and walked away rich. Marsh, now hollowed out and crippled by rent payments it could never afford, collapsed into bankruptcy. And this story is not a rare exception. The data is just chilling. Rigorous academic studies have found that companies acquired through these kinds of leveraged buyouts are 10 times more likely to go bankrupt. Let that sink in. 10 times. For many in the industry, this isn't a bug in the system, it's a feature. And this isn't just about corporate finance. This has a massive, devastating human cost. We're talking about mass layoffs. For the employees at Marsh, their pensions were left underfunded by millions of dollars, with the bill getting passed to a government agency. Entire communities that depended on those grocery stores were turned into food deserts. And in the most disturbing cases, like in healthcare, this relentless focus on cost-cutting has been linked to higher death rates in PE-owned nursing homes. This is the brutal reality behind the billionaire's portfolio. So, we've seen the glorious success and we have seen the brutal reality. This is how the rich build and protect their fortunes, which brings us to the final crucial question. Should you try to copy them? The experts are crystal clear on this. It is incredibly dangerous to blindly copy another investor's moves, no matter how rich or successful they seem to be. And the reason is simple. Your goals, your time horizon, your ability to take a hit, they are completely different from a billionaire's. For a normal investor, private equity is a minefield. The fees are astronomical. They can eat up 6% of your money every year. Your cash is illiquid, meaning it's locked up for a decade, maybe more. And here's the real kicker. You can't even get into the best funds anyway. Those are reserved for the ultra-wealthy. You're left picking from the leftovers, and it's a total lottery. And just look at this chart. It tells the whole story. Yes, the top quarter of PE funds absolutely crushed the market. But the bottom quarter? They were an unmitigated disaster, losing almost a third of their investors' money. Picking the right fund is everything, and as a regular investor, the odds are seriously stacked against you. This brings us back to the most important point of all. If you have $100 million, you can afford to put $5 million into a high-risk fund.
If it goes to zero, it's a disappointment, but it doesn't change your life. For most of us, losing that same percentage of our net worth would be catastrophic. The wealthy are playing offense with money they can afford to lose. You are playing defense to secure your retirement. You are not playing the same game.
So here's the crucial takeaway. You have to separate the allure of a secret strategy from your own personal reality. It's fascinating to see how the ultra-wealthy invest, but the exact strategy that works for a billionaire might be the very thing that completely derails your financial future. The goal is not to invest like the rich. The goal is to invest what's right for you. Building wealth isn't about chasing a secret billionaire formula. It's about avoiding the big traps that keep most investors stuck. And blindly copying a playbook that wasn't written for you is one of the biggest traps there is. Start consistent, stay disciplined, and let time and sensible diversification work their magic. If this helped you see investing in a new light, please like, subscribe, and share it with someone who needs to hear this. Here at Invest Education Hub, we turn financial complexity into clarity, one smart decision at a time.